From New York City for our viewers worldwide, I'm Sonali, Basak, and Bloomberg Real Yield starts right now. U.S. inflation cools but gets tossed aside in the market upheaval as sentiment sours and the trade war ignites. The long end of the Treasury curve sees yields spike higher as some investors start to question its safe haven status. And credit risk spikes higher across the globe as China raises tariffs on all U.S. goods even higher. But we begin with the big issue, trying to make sense of a hectic time in markets.
I think what we are seeing is a complete repricing of U.S. assets with a higher risk premium.
We have seen a very unusual move in asset prices.
Uncertainty doesn't do it justice.
Completely switching around the world order of the last 40 years.
We're embarking on, a radical shift in, the world order.
China's saying time out. We own nearly $1 trillion U.S. treasuries, and we're not taking this.
That's the risk, is that you see that risk-free rate no longer be risk-free.
So the next 90 days is going to be quite volatile in the bond market.
The bond market had a fit, in this sell-off.
The basis trade very well could have forced Trump's hand, and I don't think it's wrong to think that based on what's happened just in recent days with yields.
If you can buy and hold, then certainly you can tolerate some of this volatility. But if you're trying to trade treasuries, good luck.
I want to take a look at how the 10-year yield has moved since President's tariff announcement last week. Over 8 days, you've seen it jump past 4.5%. We've reached the highest level since February. Of course, that's been more than a 35 basis point move in the 10-year yield alone. I also want to look at the 30-year yields, hitting the highest level since January. Another 40 basis point move there, getting closer and closer to that 5% level, which could be painful for a lot of investors, particularly corporate debt holders, and as well as also mortgage markets, which could face higher rates, just ripple effects across the economy. And here's one of them as well. I want to show you what it looks like to see what credit risk feels like under the market. We are looking at global credit risk, fear gauges, and investment grade debt really rise. And not only to the highest levels we've seen all year, these are really the highest levels we've seen since the wake of the pandemic. So certainly a significant amount of stress in the market, but it all starts with that Treasury market. Now, the bond markets certainly seem to have an impact on the White House's decision to put a pause on bigger tariff rollouts. At first, Treasury Secretary Scott Bessent downplayed the market's role, only for President Trump to admit that the Treasury market did, in fact, play a factor.
This was driven by the president's strategy.
Watching the bond market is very tricky. I was watching it.
He and I had a long talk on Sunday, and this was his strategy all along.
I saw last night where people were getting a little queasy. They were getting yippy, they were getting a little bit yippy, a little bit afraid.
The market didn't understand. Those were maximum levels.
But if you look at it now, it's beautiful.
Joining us now, Ed-AlHussainy, global rate strategist at Columbia Threadneedle, and Mike Contopoulos, deputy CIO at Richard Bernstein Advisors. Want to take the 10-year first because you're looking at the Treasury markets overall face the steepest sell-offs since 2019. That is when the Federal Reserve had to intervene in the center of a liquidity crisis. Mike, when you look at what's going on right now, the move has been sustained throughout the week. We hit 385 on the 10-year. We are now at 452. What are levels that get you more concerned? When is this, as Jamie Dimon calls it, a kerfluffle?
Yeah, listen, I think that we're not probably that far from where you start getting either an increase in Treasury buybacks or the Fed, some sort of Fed intervention. But I could definitely see the 10-year quickly get towards 4 3/4 or even 5%. I mean, it's not like we haven't hit 5% in the post-pandemic period anyway. It's just the volatility that's really concerning. I personally think, Sonali, this is an unbelievable opportunity for fixed income investors. As you know, we've had almost no corporate credit risk in our portfolios. And if you can add duration at 4 3/4, 4.5%, 5%, this is a really, really good opportunity. And so, listen, I think you're getting closer to that period where either Treasury or the Fed starts to get concerned, and that means it provides an opportunity for investors because the volatility should start to subside a little bit after that occurrence.
Now, Ed, do you dip in? Do you dip in hard at this level with this volatility? Because you have been calling for most of the year for this 10-year to end closer to 3.5%.
We should have had this conversation last week, but here we are. I think you leg in slowly. I think one of the speakers said this is a time to be queasy, and that's correct. The moves are very violent. I'll make two observations. One, duration as a whole globally has done a lot better than what we've seen in the Treasury market. German bonds have outperformed. Japanese debt has outperformed. So there's a case for diversifying duration globally, and I think that's step one. And second, financial conditions are tightening. So from a credit perspective, there is an opportunity set today that's much richer than where we were just 6 months ago.
Now, I want to also, Ed, pull up, you bought me this piece of paper today, and it has 4 scenarios on it. One of them is chaos. Chaos defined by financial crisis, Treasuries, USD, safe haven status collapses, war, and a Chipotle bankruptcy. I assume that part is a bit of a joke. But when you think about the probability of outcomes, particularly the most dire ones, what is it?
I think when it comes particularly to Treasury market functioning, we've had a lot of yellow flags go up in the course of the last week. We're still not at a level where the Fed will intervene. And I think the good news is we have the toolkit. We've used it in the past. We used it after the COVID crisis. We used it after Silicon Valley Bank, and of course in 2019. So the toolkit is there. What's the threshold for the Fed to use it? We're not quite there, but I think we're definitely quite close.
Mike, what do you think the biggest reasons are to worry about further sell-offs in the Treasury market at this juncture? There are a huge range of reasons, but I'll take 2. A foreign buyer's strike being one big risk that people are talking about, and leverage in the system. That was something that Treasury Secretary Scott Bessent earlier this week said was an issue to the earlier part of this unwind. Moving forward, what's going to be the cause if we see one?
I think those are absolutely 2 of the key causes. I think the third, which of course Bessent did not hit on, was long-term inflation expectations really skyrocketing. Listen, you probably still have, quite frankly, if you go into a huge growth slowdown, 5, 6, 7% unemployment, negative earnings growth, et cetera. If that were to happen, later this year, next year, whenever, I still think Treasuries will be the safe haven asset. However, when I look out past 10 years, so you look at the 20-year, you look at the 30 years examples, they're probably not going to rally nearly as much as in past cycles. And so the reason for that, we have the deficit, of course, but I think it's really the long-term inflation expectations, an inflationary impulse through tariffs and deglobalization and a change in demographics that the market's really waking up to. So for me, it's that inflation component that's really going to be that third component.
You were a huge voice this week at the markets. I've seen you cite it over and over about the leverage part of the unwind. There are complicated dynamics between how funds have been trading Treasuries, whether you're looking at the swaps market or the hedge fund basis trade, which didn't seem to cause the same blow up now as it did in 2019. What are you worried about when it comes to positioning, Ed?
Yeah, I think 2 things are happening. One, we went into this relatively long. I think markets were anticipating some volatility, particularly in risk assets. We got it, and so we went into this relatively long. The second thing is balance sheet capacity across markets right now is significantly diminished versus where we were even 2 months ago. And so whether that's in the leverage part of the market, hedge funds, asset managers, foreign buyers, trading desks, that balance sheet capacity is being pulled back. Margins calls are going up. And so the ability to intermediate the Treasury market is definitely diminished. And so that's what I worry about, that pullback becoming a little bit more violent.
How long does this become a situation that remains so volatile, Mike? If you think about what will actually create some calm in this market, given the macro uncertainties, even beyond tariffs, what do you need to see for this to be a market that moves in a direction that's not so tumultuous?
Probably, unfortunately, you need to see one of 2 things happen. You either need to have growth stabilize and inflation start to fall, or you need really to find a bottom on growth, right? Which could take some time. I think if we think about the next 6 to 12 months, it's going to be a pretty volatile and rocky period for all assets, not just treasuries or credit, but also equities. We've sort of, thought of the markets this year as being an Act 1 and an Act 2, Act 1 being defined by stronger growth, and Act 2 being by weaker growth. And I think everything we've seen with the uncertainty around Washington has really pulled forward Act 2 a little bit. And that's not a process that's going to be quickly resolved, especially as earnings were already peaking and as growth was already slowing. And so unfortunately, Sonali, I think this is going to be a bit of a slog. And I think we need to basically hit bottom, which could take some time.
How much of a risk is the fiscal situation in the U.S.? We're getting to the point of the story where we have to talk about it. There's an X date that is generally on the table. Ed, is it a big risk in the future, given that we've already seen at least one ratings firm come out and draw concerns about the outlook?
Yeah, I mean, it's interesting. It's happening in an environment where growth expectations are being taken down. And so incrementally, having some fiscal stimulus is not that bad. At the same time, particularly the conversation that's happening on the Senate side at the moment is a significant expansion of the deficit for the foreseeable future. It's coming at a point of weakness in the Treasury market in precisely the wrong time. So I think that fiscal risk premium is something you are seeing, particularly in the long end of the curve, the 10-year and the 30-year part of the curve for sure right now.
Ed, we thank you so much for your time. Ed-AlHussainy of Columbia Threadneedle and Mike Contopoulos of Richard Bernstein, both of you, I hope you have a great, restful weekend because, of course, it's been a heck of a long week. Now, coming up, the auction block, market volatility causing credit risk to rise across parts of the credit market. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield, and it's time now for the auction block, where issuance, or the lack thereof, had drawn the attention of many bond watchers. Starting with Treasuries, we had the highly anticipated auctions for the 10-year and the 30-year, and both had healthy demand, signaling there are still plenty of buyers. The 30-year auction yield, though, had hit the highest level since January. Over in U.S. high-grade sales, basically on hold, as there were 3 shutout days for sales this week, with only 5 deals coming to market. This follows only 4 sales all of last week. Total volume coming in close to the bottom end of dealers' expectations. And when speaking of credit, you have to look at the widening of spreads, which potentially have room to widen even further. This comes as we saw fears about corporate credit defaults escalating, driving overall credit risk higher. Speaking of credit spreads, Kelsey Barrow of JPMorgan says they're too narrow to reward investors for the amount of risk that we're seeing in the economy.
Each day that we exist in this environment of high uncertainty and tightening financial conditions does unfortunately raise the prospects of recession and suggests that credit spreads are probably not wide enough to compensate us for that risk.
Joining us now, Lotfi Karoui, Chief Credit Strategist at Goldman Sachs, and Ashley Allen, Global Credit Strategist at JPMorgan Private Bank. And I know both of you come from the same lineage here, but Ashley, just starting with you, wondering if you think that spreads could widen materially from here. Working at a private bank situation, do you tell your clients that there's anything to be picking at given the spread widening?
Yes. Broadly speaking, we do think credit spreads could widen from here. The magnitude of which, though, is going to depend on policy and just the uncertainty that we hear coming out of the administration or just in the economy in general. That said, though, to your guest's previous point, we do think it's still a very interesting time to get involved in fixed income for our clients, and so our messaging there hasn't been the same. We have adjusted a bit, though, to suggest clients stay up in quality within credit ratings, given the volatility that we're seeing and given the uncertainty with spread widening. Specifically, I'll just highlight in investment grade. We like single A's right now. We're seeing a little bit of a pickup to the typical spread compression to triple B's. So up in quality, get a little bit more defensive, but broadly speaking, investment grade credit still attractive. That's the message we're communicating to our clients.
Lotfi, I also want you to speak here to flows. Ashley signaled where flows could be going, but I want to talk about what we saw this week. You've called it Flow-mageddon. You had U.S. high yield and leverage loan funds experiencing their largest outflows ever. It was a shock, as you had written. How much more pain do you think those riskier parts of the credit markets might see? And is it on a fundamental basis, or is it because of the flows?
Well, I think, demand technicals in general have been sort of the bedrock of credit markets for a number of years now. And so this was truly the first negative shock to demand technicals we've seen in a number of years. We're keeping a very, very close eye on that because, as the previous guest kind of said it, if you look at the value proposition of credit from an all-in yield standpoint, it actually doesn't look that bad. High yield is at 8.75%, 8.5%. IG is around 5.25%, 5.5%. And so relative to the equity market, that's a pretty compelling value proposition. However, things have shifted this week. I mean, for the first time in a long time, we're seeing the correlation between rates and spreads move to positive territory. That's bad news because that means that as spreads widen, the ability of duration to provide you with that hedge against, a risk-off scenario has also eroded. And so your price returns are going to come under pressure. So I'll take it one day at the time here. But I would say, in general, we would be still quite selective. And we do expect the direction of travel to be skewed towards more spread widening on a forward basis.
It's the real yield kind of day when you have both terminal viewers watching and writing in, as well as ones online on X. Okay. And a good question here is, how do you think about products tied to credit like the ETFs, where there are concerns, and you saw some decoupling with net asset value and what you saw in the trading of, for example, CLO ETF just this week. Do you worry about the ETFs tied to the bond market at this point, Ashley?
At the moment, no. Their liquidity still seems to be present in the market. So to the extent that, again, we have long-term investors that choose the ETF route instead of maybe the single line item route, I don't think you necessarily have to be concerned longer term. In the near term, just given the volatility, we may continue to see a little bit of a disconnect. But if anything, I would argue that potentially is an opportunity for clients to get invested at the higher yields. Again, long-term investor here needing to be able to stomach some volatility, but again, opportunistic.
How do you feel about this dynamic of market structure, Lotfi? I mean, there are just so many more ways for investors to get in, and those ETF products have been the way that retail investors have been able to access the bond market of late.
Yeah, I mean, I completely agree with what Ashley was saying, which is, I know there's been a lot of negative buzz about market fragility on the Treasury side, but I would say the one silver lining in credit is that as violent as the price action has been, it's been actually quite disorderly, and I think ETFs have actually kind of played a big role in that. And so we've seen a couple of days where the NAV basis kind of moved, in a volatile fashion, but it was nowhere near sort of the levels that we had in March 2023 on the back of the SVB failure or prior to that during COVID. And so for now, I would say the microstructure of the market or the plumbing of the market is actually holding up remarkably well. And I think that's a good thing because it avoids a scenario in which, you see gappy price action and spreads kind of moving in a nonlinear way. And so I would say for now, that's been a net positive for the market, 100%.
Ashley, I want to differentiate between investment grade and high yield at this point in time. How worried are you about lower rated securities at this juncture? And are you sitting there at JPMorgan with that pencil out looking security by security on tariff exposure to China and other countries?
Yeah, so we are. To answer your first question, triple Cs broadly concern me at the moment. That's where we would expect to see a pickup in default or default risk, especially heading into a slower macro, even holding tariffs aside. But some of those lower rated companies will likely see stress in the near term. Maybe they won't be able to tap the market to refinance their debt. There may have to be some restructuring. So we have concern there. We've been avoiding it. Similar to IG and high yield, we've been recommending up in quality. So that's more of those BB type rated credits there. With respect to companies that can be impacted by tariffs, kind of consumer discretionary broadly, or consumer is taking it on the chin recently and has been. I would say I'm very cautious with respect to that broad sector at the moment, just given the exposure maybe to China, Vietnam, Cambodia. I'm concerned about the ability for those companies to pass along potential price increases to the extent that tariffs do become sticky. That said, for companies that have strong balance sheets and pricing power, good brands, those could be winners.
Ashley, we got to leave it there. That is Lotfi Karoui of Goldman Sachs and Ashley Allen of JPMorgan Bank. Out of time, and I could go for the full hour, I swear. It's been such a crazy credit market, but still ahead, we have the final spread, which will give you the week ahead, which includes more bank earnings, tariff fallout, and central bank decisions from around the world. This is Real Yield on Bloomberg.
With investors on edge as tariff headlines spark volatility across global markets, Bloomberg Surveillance has the insight and commentary to give you a jump start on the trading week. Tune in for special coverage this Sunday starting at 6 p.m. Eastern. Context changes everything.
I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, Monday, EU foreign ministers meet with tariff strategy front and center, plus earnings from Goldman Sachs. And Tuesday, bank earnings continue with Bank of America and Citigroup. Plus, it's tax day. File your taxes. Don't forget. I do mine back in January, I think. Wednesday, Fed Chair Jay Powell speaks U.S. sales data and regional bank earnings. Of course, every piece of economic data being watched very closely. And Thursday, we have an ECB rate decision, plus earnings from TSMC, Blackstone, Netflix, and more. Friday, more global markets are closed for Good Friday. And before we let you go, we're going to take a check on those yields as we close out the half hour, because we, of course, are watching some stunning moves on the week. That 10-year has broken out of that 4.5% trading range, and it has gone higher, now back to that level and fluctuating around it, a relative set of calm for a week that has seen drastic moves higher and another nearly 8 basis points today. The 30-year yield now below 4.9%, but still higher on the week. And from New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg.